Firstly, a very good evening and a warm welcome to everyone present. I take this pleasure to introduce to you our distinguished guest speaker for today, Mr. Erik Norland. Along with this, our team members of APM Capital Limited are also present for this webinar session. We would like to begin the session by introduction of APM Capital Limited, and for this, we have Mr. Nick Spencer-Steen, our SEO. Over to you, Nick.
Good evening and a warm welcome to everybody. Yeah, I'm Erik Norland. I'm the SEO at APM Capital Limited. So we at APM Capital Limited, we started our journey May 21 and we're headquartered in Abu Dhabi. We're authorised and regulated by the Financial Services Regulatory Authority in the Abu Dhabi Global Markets ADGM. So at APM, our vision is to continuously strive to provide our clients with an unparalleled trading experience that is always fair and transparent. So providing access to CFD and exchange traded markets to retail and both professional clients. We provide immediate order execution and our trading platforms cater to many with unique and innovative tools, all the while ensuring the highest levels of security. So we're really excited to have this collaboration with the CME Group and to have this series of webinars commence this evening. And we're delighted to have Mr. Erik Norland with us. And I'll ask our host, Natasha, to now make a formal introduction. Thank you very much.
Thank you, Nick. So before commencing with the webinar, we would like to give you all a short introduction about our speaker for the day, Mr. Erik Norland. Erik is the Executive Director and Senior Economist of CME Group. He is responsible for generating economic analysis on global financial markets by identifying emerging trends, evaluating economic factors, and forecasting their impact on those who trade in its various markets. He is also one of the CME Group's spokespeople on global economic, financial, and geopolitical conditions. Prior to joining the CME Group, Erik gained more than 15 years of experience in the financial services industry, working for investment banks and hedge funds, both in the US and France. He holds a bachelor's degree in economics and political science from St. Mary's College of Maryland and MA in stats from Columbia University. He is also a CFA Charterholder. We are glad to have you here with us on board, Erik. Thank you for joining us today. So now the stage is all over to you. So we'll start the webinar on energies by Mr. Erik Norland. Also, I would like to mention that in case you all have any questions during the webinar, you all can just add it on the chat box. And once the webinar ends, we'll discuss the questions in the chat box and we'll also have an interactive Q&A round at the end. Thank you.
Well, thank you so much for the introduction, and thank you to everybody for being here. It's a tremendous pleasure to join you this evening from London, where, as I'm sure you have gathered, we have had plenty of excitement in recent weeks in terms of economics. It's part of a very, very challenging time for the entire world, including for the energy markets. Before we go into the heart of the presentation, I am required to show you both the short version as well as a longer and more detailed version of CME Group's disclaimers. Our disclaimers essentially say that because CME Group is an exchange operator and not a broker dealer or an investment bank, we are unable to give you any sort of financial advice. So today we're not going to be giving any financial advice or trading advice. What we will be talking about is markets and how markets price various outcomes and what the upside risks and downside risks are to various energy markets and how those energy markets relate to a variety of other things that are happening outside of the energy markets, including what's happening with interest rates, inflation, equity markets, what's happening to economic growth in places like the United States, China, and Western Europe. And so hopefully you'll find it informative, and we'll have plenty of time for questions at the end. I think that the most basic place to begin any discussion of markets is to ask the following question, which is what scenario is already priced into the market? And in some ways, I think this is actually a really surprising scenario. When you look at West Texas Intermediate crude oil futures, they have a scenario that's actually fairly bearish priced into the market. The December 2022 contract is trading right now at around $85 per barrel. But if you look out to December 2023, the market essentially thinks that the price is going to be down to around $73 per barrel. If you look out to the end of 2024, prices are below $70 per barrel if you want to buy them that far out. So this is what we call backwardation in the futures markets. And it's an indication that traders for the moment don't see prices staying high. They think that the most likely outcome is that prices are going to go lower. Now, I would point out that this is sort of the path of maximum likelihood. And around that, there's a very wide probability distribution. So there are risks both to the upside and to the downside with respect to this sort of market view of the most likely path for prices. When you look at product markets like gasoline and ultra-low sulfur diesel, ultra-low sulfur diesel used to be known as heating oil. So when you look at gasoline and diesel and heating oil markets, they are also in backwardation. The markets think that over the next few years, their prices are likely to decline. And in particular, the markets are expecting a really big decline in the price of diesel. Currently, the near-term contracts are trading at around 415 cents per gallon. And the market thinks that's going to go down to around 265 cents within the next few years is the most likely possible outcome. So why is it that markets think that that's going to happen? Well, in some ways, I think this scenario that's priced into the futures contract curves is a very, very surprising scenario. It's basically a scenario that says that the reasons why oil prices are high today and product prices are high today are just going to be temporary, and those reasons are going to go away. So what are the reasons? Well, the first reason, I think, is that inventories are very, very low at the moment. When you look at the inventories of ultra-low sulfur diesel, you can see 2022 down here. It's in the light blue line. And you can see it's very, very far below the inventory levels that we had for ultra-low sulfur diesel at similar points in the year in 2021, 2019, and 2018. And of course, very far below 2020, which was influenced by the pandemic. Same thing is true when you look at gasoline. Gasoline inventories are also extremely low. So one thing I think is kind of mysterious is how can you reconcile the really low levels of inventories today with this expectation that prices are going to fall in the future? I mean, when I look at this, I ask myself the question, well, shouldn't low levels of inventories today cause prices to go higher in the future? Isn't this an enormous upside risk to the market? And so I suspect that this actually is a major, major upside risk, especially when you take this into the broader context. Since many of you are based in the United Arab Emirates, I'm sure that you are aware that OPEC recently cut production by 2 million barrels per day. That essentially takes 2% of global production off of the world market. And that, that's a pretty big deal. So you would think that the combination of low inventories plus reduced production would, if anything, cause those curves, which are negatively sloped, to become more flat or maybe even positively sloped. So, one thing you can ask yourself is, are those curves really correctly pricing the risks? On top of that, we also have a war going on between Russia and Ukraine. And the fact of that war going on, I think, is adding a lot of stress to global supplies. There are many countries that are refusing to buy Russian oil at the market price. They're essentially establishing a counter cartel, if you will, that says, well, we're going to refuse to buy Russia's oil at that price. So Russia's looking for new customers, trying to send oil to India and to China, even though they don't necessarily have the pipeline capacity to do that very easily. So it's a very, very challenged situation. When you look at crude oil inventories, those are not so bad. Crude oil inventories in 2022 are actually running slightly higher than they were in 2018, 2019, or 2021, but not much higher. So the crude oil market itself looks a little bit more balanced. But when you take crude oil and combine it together with the products. So gasoline, diesel fuel, heating oil, gas oil, et cetera. What you see is the graph on the right. And the combination of all of these markets indicates that inventory levels are actually, on the whole, slightly lower than they were in most previous years at this time of year. And I think that that's potentially quite bullish for the oil market with respect to this forward curve that's very, very negative on where oil prices are expected to go. So we have low inventories. We have the fact that OPEC is cutting back, or say OPEC plus, because that now includes Russia, cutting back production by 2 million barrels per day. But there is one other thing that I think is really, really bullish for oil going forward, and that is in the United States. In the United States, during the 1980s and late 70s, the United States concluded that it was necessary to begin stocking huge amounts of crude oil. The United States, up until the early 1970s, had been a net oil exporter, but U.S. oil production fell a great deal during the 1970s and 1980s. And as a result of that, the U.S. was eventually producing only 5 million barrels per day, but it was consuming 14 million barrels per day. So it had a tremendous energy deficit. And that created a risk for the United States that if it ever got into a war and its oil supply was cut off, that it could no longer operate its economy and its military simultaneously. So during the 1980s and really up until about 2009, the U.S. built up a tremendous reserve of petrol that came to about 700 million barrels of petrol, which was essentially enough for the United States to, with no domestic oil and no foreign oil production at all, to essentially power itself for years. And then since then, the United States has occasionally drawn down its strategic petroleum reserve. But during the last 6 months, Joe Biden, the president, has essentially ordered a large portion of it to be liquidated. So the U.S. has been selling 1 million barrels per day. But this is all coming to a screeching halt at the end of October for a variety of reasons. First, the petroleum reserves are getting too low, so they're making the military in Washington a bit nervous. The U.S. now is more or less energy self-sufficient, but not entirely. And so also the midterm elections are happening in early November. So once the midterm elections happen, there's no particular political reason to suppress the price of oil. So essentially, when the U.S. stops selling this oil, it's going to take the equivalent of 1% of global production off the market. So OPEC is cut by 2 million. This will essentially cut the equivalent of another 1 million barrels per day. So we've now eliminated 3% of global supply. There is a sort of rule of thumb in energy markets that if you remove 1% of supply, you might get a 10% increase in price, at least in the short term. So we've removed 3% of supply, and yet when you look at the prices, they really haven't increased all that much. In the last few weeks, we have seen a bounce in crude oil prices in West Texas. We've also seen a bounce in gasoline prices. We've seen a bigger increase in the price of ultra low sulfur diesel, otherwise known as heating oil. But we haven't really seen huge increases, not the kind of increases you might expect to see. So what's happening? Why is it that oil markets haven't reacted more to this kind of news that we've had in the last few weeks? What else is going on? And so there are both answers on the supply side as well as on the demand side. Let's look at the supply side first, and then we'll talk about the demand side later. Part of the issue, I think, is that even though OPEC is cutting supply and the U.S. Petroleum Reserve is going to stop its drawdown, U.S. energy production has been rising a little bit. It hasn't risen a huge amount, but over the last couple of years, it's gone from 10.5 back to 12 million barrels per day. And there is a possibility that if prices go higher, that we might see additional U.S. oil production. This has gotten a little bit difficult because the Biden administration has basically said that that the United States is no longer going to be fracking on public land. They've reversed that a little bit in recent weeks, but the number of fracking permits is still very low on public land. But the good news for the U.S. oil producers is that about 90% of the fracking production in the U.S. happens on private land. Only 10% is on public land. We might see some further growth in that. In the past, now here we have oil production. Oil production here is in black, and the price of crude oil is in blue. In the past, high prices for crude oil have often stimulated additional production of oil in the United States. And that seems to have been the case recently. One indicator that people often look at when they're looking at oil production is the number of operating rigs. So here we have oil production in black still. We have the number of rig counts in blue. And the rig counts had been increasing from very, very low levels. But this is a very complex story. So I think when we delve into the U.S., it's very interesting because the OPEC countries, essentially the governments all control the amount of production. So if the government in Saudi Arabia decides to cut production, then the local oil company Aramco cuts production. Same thing is true in Iraq, the UAE, Iran, Venezuela, Russia, etc. This is not true in the United States. In the United States, there is really a true free market for oil producers. So they are responding almost purely to market incentives. And at times, this makes the U.S. the swing producer of oil. So what's happening in the U.S.? Well, in the United States, there are 7 oil-producing regions that the frackers operate in. And the biggest one is the sort of brown-colored region that you see there in southwest Texas called the Permian Basin, or just simply Permian on our charts. And you can see that Permian oil production has increased a great deal. It was always the biggest of the fracking regions in terms of oil production, but it's the only one that continued to grow after the oil price collapse in 2015. We'll get to the reason why that is in just a minute. But all of these other regions, the Bakken, Eagle Ford, Niobrara, the Anadarko region, their production of oil is all kind of stagnated in recent years, and for the most part is lower than it was 7 or 8 years ago, back in 2014 and 2015. But essentially, there's a very simple equation, and the equation is that the amount of oil production is equal to the number of operating rigs multiplied by the productivity per rig. And so as you can see here, in terms of rigs, the Permian Basin is where almost all of the investment has gone into. And what's interesting is the number of operating rigs, even there, has declined from where it was before. So what we've seen is, at least up through 2021, a sort of productivity revolution where we get more and more oil per rig. And so that kind of went through at the end of last year. Now rig counts are starting to rise. The activity is beginning to decline, but rig counts are for the most part rising more quickly than a decline in productivity. So now the question, why the Permian, and what would it take to get investment out of all of these other regions, or investment into the other region in oil to start increasing its production in these other regions? So the thing is that Permian is just better connected to the rest of the world than most of these other regions are. And the reason is it has a pipeline, or actually several pipelines. One pipeline goes from Midland, which you can see on top of the Permian region there, and it goes to Cushing, which is where West Texas Intermediate crude oil is priced and are stored at in various facilities. And so it costs only 80 cents, or $0.8, to ship a barrel of oil from Midland to Cushing through the pipeline. Likewise, it can go from Permian Basin from Midland to Houston for $2 per barrel equivalent. You compare that to the other regions in the United States, from the Bakken region up in North Dakota, the Yellow region, it costs $7 to send it by rail, or $12 to Cushing, or $12 to send it by rail to Houston. So the reason why the Permian Basin gets all the investment is very simple. It's because the transportation costs are lower. And the reason for that is that it's better connected by pipelines than most of these other regions are. So you have, I think, a big reason why the investment is going into that one particular region. And when you look at how the Permian responds to oil prices, so here on the left we have Permian rig counts versus the price of oil. You can see that when the price of oil rises, the Permian rig count rises right along with it. It's very, very simple relationship. With the other regions, the relationship is not as strong. With Anadarko, Bakken, Eagle Ford, Niobrara, oil prices have to rise a lot more in order to incentivize production because of those higher transportation costs. But this does in some ways limit the price of oil. So imagine a sort of disaster scenario where the price of oil goes up to $200-300 per barrel. That would make it very easy to produce oil in all of these other regions, and U.S. oil production could potentially increase by millions of barrels per day. It would not happen overnight. When oil prices move, it takes about 4 months to get the rigs into place. Once the rigs are in place, it takes another 4 months or so to begin producing the oil. But probably within about 8 to 12 months, the U.S. could come in and start flooding the world market with oil. So that's why we think the U.S. still remains a swing producer of oil, and why West Texas Intermediate remains an incredibly powerful benchmark for evaluating what's happening with that particular commodity. Now let's switch gears a little bit and talk about how oil relates to a couple key agricultural markets. So this, I think, is one of the strangest graphs, probably the single strangest graph in the presentation, and a reason may not jump out at you immediately. So here we have West Texas Intermediate crude oil in black, and we have soybean oil in blue. So you may be wondering, who cares about soybean oil, right? Well, I first started presenting these graphs to farmers because a lot of futures, in fact, all of the futures contracts originated in agricultural markets. The oldest ones were corn and wheat, going back to the 1800s. And then the soybean future, which trades at CVOT, one of our exchanges, goes all the way back to the 1930s. And all of the other futures are more recent than that. So we still have a lot of clients in the agricultural space. And so I would present this to them because they would often ask, so what is the oil market telling us about agricultural goods? And I would often argue to them, well, actually, you should think about it the opposite way. What are agricultural goods telling us about the oil market? So when you look at this graph very closely, you can see back in 2006, for example, soybean oil prices rallying, crude oil prices had come back down, but soybean oil prices seemed to almost predict this huge, huge run-up in crude oil prices that took place in 2007 and 2008. Then you might notice that soybean oil prices peaked in January 2008, which was about 6 months before the peak in crude oil prices. Then soybean oil prices came down a great deal before crude oil prices dropped, and they hit bottom in December 2008. Crude oil did not hit bottom until February 2009. Then soybean oil began a rally that began before the crude oil rally did, and it peaked out in 2011 before the peak in crude oil. Then soybean oil prices started this long slide in 2012, 2013, 2014. It anticipated the crash in crude oil prices at the end of 2014. Then soybean oil prices hit bottom in November 2015, which was 4 months before the bottom in crude oil in February 2016. Since then, lots of the little local peaks and local valleys have happened in the soybean oil market before the crude oil market, including the bottom in March 2020, which came a couple months before the bottom in crude oil prices, as well as the most recent peak. Soybean oil prices hit their high point for this year in May. In early May, crude oil prices did not peak out until the end of June. You see the same pattern when you look at Bursa Malaysia's palm oil prices, which also seem to be a leading indicator of what's happening with crude oil. So why is this the case? Well, I think it's because 65 countries around the world, including the 26 nations of the European Union, the United States, China, Brazil, many other countries have biofuel mandates that require that some sort of biofuel, could be ethanol from corn or sugar, could be vegetable oils like palm oil or soybean oil, get mixed into the final product blends. And so the soybean oil market and the palm oil market are quite large markets. You can trade these in significant size, but they are very, very small compared to crude oil. Their trading volumes, I'd say, are about 4% of the crude oil volume, or in other words, about 1/25th the size of crude oil. And so it seems that when there's an incipient shortage of crude oil, the refiners call up these farmers and basically say, hey, we need more palm oil, we need more soybean oil. And because the markets are small compared to crude oil, you see an outsized move that anticipates a later move in crude oil prices. And the opposite happens when there's too much crude oil. In that case, there's this pushback. People say, okay, no, we have plenty. We don't need any more from the farmers. Thanks. And so palm oil and soybean oil prices drop in anticipation of a potential later drop in crude oil. So I pay very close attention to these markets. They had a bounce in recent weeks, particularly soybean oil bounced a few weeks ago. Now we're seeing the bounce in crude oil prices, but soybean oil has been coming back down a little bit. Palm oil has been looking very unhealthy in the last few weeks. This may be an indicator that that rally in crude oil does not last. Despite the OPEC production cut, despite the end of the drawdown in the Strategic Petroleum Reserve, it might be that the forward curve actually turns out to be right, and that oil prices do in fact slide, as most traders seem to think is going to be the case. So why would that be? Well, let's take a look at the demand side. What's the main issue in the world economy right now? Well, for most countries, the main issue is inflation. And that's certainly true in the United States and in Western Europe, where inflation rates have gone up to extremely high levels. And so this is really, very, very problematic. These economies have all overheated. Employment levels, or unemployment rather, has fallen down to extremely low levels across all of these markets. In addition to that, you have employment has completely recovered from the pandemic, and employers are looking to hire millions and millions of new people. So you might think this is all great for oil demand, and in the short term, you're right. The fact of people being employed and prices rising means that for the moment, oil demand is probably very, very strong. But there's a reason to think this is not going to last. And so one of the reasons why we think this is not going to last is because central banks are dramatically raising interest rates. In the United States, the Federal Reserve so far this year has raised rates by a total of 300 basis points. The market is pricing that they go another 150 basis points between now and the middle of December. If they do that, it will be the largest rate increase since 1979. What happens when the central bank increases rates? Well, it slows down economic activity. We're already starting to see a lot of stress in various parts of the economy. In the United States, for example, mortgage interest rates have tripled. They've gone from 2.8% to over 7%. This is slowing down housing construction. We're starting to see a lot of strain on consumers. House prices are starting to fall in many countries, including here in the United Kingdom, where I live. They could also raise interest rates a great deal more because despite all of their interest rate increases, interest rates are still below the rate of inflation in most countries. In the United States, for example, inflation is at 6.5% on the core. The Fed recently raised rates to 3%, so they have a negative 3% real rate. This is why central banks are panicking and raising rates. In the United Kingdom, it's even worse. The United Kingdom, as I'm sure you've seen in recent weeks, our bond market completely collapsed. The trigger for it was fiscally irresponsible proposals by a new prime minister. But the central bank here in England has warned over the weekend that they're going to do huge interest rate increases. They're going to raise rates to 5 or 6% in coming months. It's going to be really, really hard for people. They're going to have a lot less money to spend. That's going to mean less travel, less driving the car, less shopping. When you go shopping, all of those goods you're buying have to come by truck or by boat or by airplane. So there's going to be a lot less demand for petrol from Europe and from the United States because of the tighter monetary and fiscal policies. So essentially, central banks are now raising rates and they are reducing the size of their balance sheets, essentially a reversal of quantitative easing. They are taking all that liquidity and are basically sucking it into a black hole. And you're starting to see this in financial markets. The equity market in the United States, the NASDAQ, has been crashing. It's down over 35% so far this year. You look at the S&P 500 and the Russell 2000 index, they're down over 20%. If you are a long bond holder in the United States or in Europe for that matter, you've seen huge capital losses. In the United States, somebody who bought at the peak of the market would have bought ultra long bond treasuries at $220, $230 per bond. I was trading at $130 per bond. That's 40% down in terms of capital losses. So bondholders are doing really, really badly. As I mentioned, central banks are now reversing quantitative easing. You can see here on the left, the Fed expanded its balance sheet enormously during the pandemic. Now it's shrinking its balance sheet. As it shrinks its balance sheet, it's essentially pulling liquidity out of markets. And the S&P 500 and other equity indices have really been struggling. And maybe the most alarming thing of all is that equity markets still have extremely high valuations. In this chart on the right, you can see the S&P 500's market capitalization as a percentage of gross domestic product. Now it's fallen from 180% to 140%, but it's still extremely highly valued. And it has a lot of potential on the downside. So it may be that the bear market that began early this year is maybe only about halfway through and also has a lot further to go on the downside. If that's the case, it will make people feel a lot less well off. If they're feeling less well off, they will consume less of just about everything, including petrol. Also, this is maybe a little bit too esoteric, but also the dividend market doesn't price any growth in corporate earnings over the next decade. If you look at the equity markets from this perspective, in this right-hand chart, judging from dividends, the S&P 500 should be trading at about 1,000 points below where it is today. If it falls that far, it's going to limit demand for oil. During the global financial crisis in 2008 and 2009, global demand for oil fell by 4%. That's bigger than the recent OPEC cut and the recent cut, or the recent stop, or the coming stoppage, I should say, of the Strategic Petroleum Reserve drawdown. That takes 3% off of the world market. So it's very possible that consumers are going to begin to pull back. Central banks have been doing all of this quantitative easing for ages, and it just can't continue because the quantitative easing has essentially addicted us to high asset prices, but it's also helped to cause high inflation. So with high inflation, the governments can no longer come in to save the economy by printing money. Now, the other really big market we haven't talked about yet is China. And so China has just huge consumption of crude oil. And the economy, I should say all commodity markets, and not all of them, many commodity markets, including aluminum, copper, agricultural goods like wheat and soy oil, corn, but also crude oil, are extremely sensitive to what happens in China. And so with China, there's a particular measure of their growth that I really like called the Li Ka-Cheng Index. The Li Ka-Cheng Index is a great forward indicator of what happens to crude oil prices. It gives you a really good indication of where crude oil prices might be at 6 months, 9 months, 12 months' time. So when China's economy accelerates, you sometimes see a rise in crude oil prices happening about a year later. When their economy slows down, you sometimes see a decline in crude oil prices also happening maybe roughly 12 months later. And so China's economy slowed down a great deal earlier this year because of COVID lockdowns. It rebounded slightly over the summer, so maybe the rise in prices we've seen is also partly related to a slight improvement in Chinese growth. But Xi Jinping is being reelected this week. And Xi Jinping has said at the party conference that he intends to continue the zero COVID policy. China now has about 2,000 COVID cases per day. If they continue this during the winter, the COVID cases are likely to go much, much higher. If they continue the zero COVID policy, that's going to mean more and more lockdowns. And as they lock down their economy, that's going to mean less demand or less reliable demand for crude oil. This may also explain why that crude oil curve is in backwardation. People are seeing weak demand from the strongest growing market in the world, from China. But COVID is not China's only problem. China has tremendously high levels of debt. 15 years ago, during the global financial crisis, China had really low levels of debt. But during the last decade and a half, their debt levels have increased, and now they're higher than what we have in the United Kingdom, in the Euro area, or in the United States. And as a result of that, China's economy is in really, really bad shape. So China has a huge amount of debt. A lot of that debt is housed in non-financial corporations, meaning basically any company that's not a bank. And a lot of that's in their real estate sector. And China, like the United States, also has a bond market. And their high-yield bond market has been collapsing. It's down over 40% in the last year and a half. So the cost of funding all of this debt in China is rising very, very quickly. So we think that this is also going to serve as a severe damper on China's demand going forward. The problem in China's economy is very simple. It's a lot like the subprime crisis that we had in the United States 15 years ago. China has a gigantic real estate sector. It's even bigger than the real estate sector was in the United States before the global financial crisis. And so as a result of that, China's economy is slowing down. You also see it in Chinese retail sales. China's retail sales are also in extremely weak shape. They're down by quite a lot. So Chinese consumers don't feel very confident, and they're not spending very much money. You also see this in the Chinese currency. Almost every central bank in the world, except for Japan and China, have been raising interest rates. So you've seen huge interest rate increases in the U.S., in Europe, in Latin American countries like Mexico and Brazil. China's central bank is going in the opposite direction. China's central bank is dramatically easing monetary policy, and as a result of that, their currency is weakening. So as their currency weakens, it makes it more expensive for Chinese consumers to buy goods like oil. And so as a result of that, Chinese demand for oil might start to decrease. The Chinese yuan has also been falling, but it hasn't fallen as much as a lot of other currencies. It hasn't fallen as much as the Brazilian real, the Indian rupee, the Russian ruble, the British pound, the euro, or the Japanese yen. So we've seen prices for oil dropping in recent months in U.S. dollar terms. Remember that most people are not on the U.S. dollar. Now, the United Arab Emirates is sort of, because the currency is fixed to the dollar, but most other currencies are free-floating, and most of the free-floating currencies have been falling versus the U.S. dollar. So for consumers in the United Kingdom, where I live, or across the channel in the Euro area, or in Japan, or China, or Brazil, or India, oil is not a bargain like it is for Americans. Americans have seen the price of oil decline, but many of these other currency areas, especially China, Britain, Europe, and Japan, the price hasn't really moved that much downwards in recent months because it's been the dollar going higher, so their currencies are going lower, so it's limiting their ability to buy oil. Now let's conclude with natural gas. Natural gas prices, as you can see, have been extremely volatile across Europe and Asia. A few years ago, European and Asian prices were similar to those in the United States. But then we've had this tremendous run-up. So what happened? Well, part of it was that during the pandemic, utility companies in countries like China and India and Russia, as well as in Western Europe, underestimated the rebound in demand. So they didn't buy as much coal or as much natural gas as they needed. So storage levels of coal and natural gas fell to unnaturally low levels. So starting about a year ago, starting in around this time in 2021, the prices of natural gas and coal across Europe and Asia started to increase very, very dramatically to many, many times the U.S. price. And since then, there's been subject to many spikes, many of which relate to Russia. You can see there's a huge spike upwards in February when they first invaded Ukraine. Then over the summer months, they started to cut Europe off from natural gas. So we've seen a huge, huge run up in prices again. Europe has a pretty decent supply of natural gas for the winter, but this is going to be a longer term issue. They're going to draw down that natural gas stock during the winter. It's not clear how they replenish it next summer unless they can start getting more natural gas from Russia, but that's going to be more challenging, especially now that somebody blew up the Nord Stream pipeline. Now, the United States can be a major supplier of natural gas. The Henry Hub price has not increased as much. The Henry Hub price is the main price in the U.S. And the reason for that is, once again, fracking and shale production. So shale gas has increased tremendously over the years, particularly in Appalachia in the eastern part of the United States, but also in Permian, where it is a sort of byproduct of oil production, as well as in Haynesville, which is a natural gas producing region. But it's also been increasing in the Bakken and many other smaller regions as well. Here too, same equation. Shale production of natural gas is equal to the number of operating rigs multiplied by the productivity per rig. One thing we've seen over the last decade is that we have seen a revolution in productivity, where smaller numbers of rigs are able to extract larger and larger amounts of natural gas. The one exception is in the Permian, and that's really just because the natural gas is just a byproduct of oil production. It's not the main reason for drilling. But nevertheless, production in these regions is rising. The U.S. can continue to supply a lot of the global market, but the U.S. is only capable of exporting a maximum of about 20% of its production. Because it has to be liquefied at LNG terminals. And then a main constraint in Europe and Asia is regasification. We lack enough regasification facilities in Europe, and the ones that we have are not necessarily where the natural gas is needed the most. For example, the best facilities are in places like Portugal and Spain, which have no pipeline connection through France to the rest of Europe. And so the regasification facilities in the Netherlands and Germany don't have the capacity to handle their needs. So I've been speaking for a while. I said I would speak for about 40 minutes or so. I think we're about 40 minutes into my speech. So this leaves us, I think, about 15 or maybe slightly less minutes, 14, 13 minutes or so for questions. If there are any questions.
Yeah, hi, thank you, Erik. The talk was indeed very much wonderful. We'll just take the questions from the chat box. Just a minute. I think there is one question. Yeah, so there's one question by Maria stating that what is driving current performance in the energy sector?
I'm sorry, what is driving what?
What is the driving current performance in the energy sector?
Sorry, my cell phone seemed to think I was talking to it. So Siri somehow got involved. So what's driving performance in the energy sector?
Yeah.
Well, I think it's the same variety of things. It's what's on the supply side, where we've seen OPEC cutting back production. We've seen the drawdown in the U.S. petroleum reserves. It's going to come to an end very shortly. We've also seen low inventories that need to be rebuilt, essentially for gasoline and for diesel as well as for natural gas. And you also have all of the economic factors, including the fact that central banks are raising rates, governments are cutting back on spending programs, and that's limiting economic growth. So it's a very complex picture with many things pulling in different directions. In terms of the equity aspect of the energy sector, I think that those companies fall broadly into two categories: as the oil majors, and then there's the exploration and production companies. The exploration and production companies, I think, are much more sensitive to the price of oil than are the majors. But the energy stocks have been doing really well in a high price environment. These companies are very, very profitable at the moment.
We have one more question: that should oil prices derive the stock prices of pipeline companies?
Okay, so should oil prices drag stock prices up for? I'm not sure I heard the rest of the question.
It says that should oil prices drive the stock prices of pipeline companies?
Oh, of pipeline companies, yeah, probably. I mean, I would think that pipeline companies will be very, very sensitive to oil prices. There's a lot of interesting things happening in terms of pipelines. Russia, for example, has to build a great deal more pipelines going towards China. Since they're no longer going to be exporting as much to Western Europe, they have very limited pipeline capacity going to China. So companies that are building pipelines in Russia going to China, that could be a very interesting investment. In terms of other pipelines, I'm a little bit less sure. I think that the bombing of the Nord Stream pipeline also shows you that pipeline infrastructure is not very secure. So that's also a concern.
We have one more question that says, can you give us some insight on price cap policy of European Union and how successful that could be?
Yes, I think this is a really difficult question, but essentially it's sort of like a reverse cartel. So on the one hand, you have OPEC, which is a producers cartel that basically says, okay, we're not gonna sell oil for less than X amount, or we'll reduce production to make sure that prices stay where we want them to stay. This is almost like an inversion of that. It's almost like a buyer's cartel, but it's a buyer's cartel that's targeting just one country. It's targeting Russia, and basically say, well, we have to buy your oil because we need it, but we refuse to pay more than X amount for it. So this creates a lot of problems, I think, for everybody, for the Europeans, but also for the Russians. From the Russian perspective, they're trying to sell their oil to China, but they don't have much pipeline capacity going to China. So they're limited what they can do. They're trying to sell it to India, but it's very, very far to go from Russia to India by water. You essentially have to go around Europe and through the Suez Canal, so it's a very long trip, or you have to go around China if you're going to take it from Vladivostok. So I'm not really sure ultimately how successful it's going to be, but it is a European effort to punish Russia for the invasion of Ukraine.
There's one more question saying how to mitigate risks through energy hedging.
Right. So, I mean, I think futures contracts and options contracts offer a lot of ways to mitigate risks. If you are an oil buyer, you could look at our forward curve and you can say, well, okay, I know I need X amount of oil going forward, so I can buy it now from the forward curve. And as you can see, those prices get cheaper the further you go out. So you could essentially lock in a low price or a lower price now, and that would protect you against the upside risk by buying a futures contract if that's what you need to do. Likewise, if you're an oil producer and you're worried about the possibility oil prices could go further down, and you could sell futures contracts along that forward curve if you want to accept those prices, and it would essentially protect you. And you can do similar but more nuanced strategies through call options and put options. For example, you could essentially buy call options on oil in the future that would protect you up to a certain point against moves in oil prices if you're a hedger, and you could sell put options if you're a hedger as well. If you're a seller of oil, that would essentially protect you, or I say rather buy put options that would protect you in the event of price downside. So there's a lot of different strategies you can use with the futures and options markets that could potentially hedge your risk.
I'm sorry to interrupt you, but I think there are a few people trying to raise hands. So maybe you all can just select the question and answer section on the top of the chat box, and then you all can add in your questions. So maybe we can read it. We have one more question saying that how successful it could be to price crude in non-USD currencies, like China is buying CNH, India in INR, to avoid USD is getting stronger for other many reasons.
Right. So I think Russia and China are trying to price deals in renminbi. So I think that they're pricing some of their trading now in a Chinese currency. I mean, the U.S. dollar still remains a very dominant trading currency. Most commodities are still priced in U.S. dollars around the world, and it's still a really very dominant currency in terms of central bank currency reserves. But there are countries that are trying to change that. There's been talk about this for years because the U.S. uses this currency sometimes as a weapon to punish countries when it doesn't like what they're doing. And so, there's always this effort to create an alternative currency. But I think the problem is very difficult because essentially everybody's agreed to meet in the U.S. dollar. So it's just sort of like the meeting place for commodity markets. It's kind of hard to move that. And I actually don't think that any other country, including China, is ready to take the global reserve currency role. Hypothetically, if everybody starts pricing commodity deals in Chinese currency, it's difficult because it's not really a convertible currency. It's very highly capital controlled. It's hard to get your money out of China, but hypothetically, if everybody goes into the Chinese currency, it could increase a lot in value, which would make China less competitive. And China still has a very export-led economy with very weak consumer spending. So I don't think that China is ready to really take on the mantle of having the global reserve currency.
We have one question on, can you advise what is the disparity between crude and Brent? Like, what disparity is based between crude and Brent?
Between WTI and Brent, I don't know. I haven't really followed it too closely recently. I don't know.
Okay. There's one more question that says, how does oil price in the US? Sorry. How does oil price drive the US market and indices?
How does oil price drive the U.S. market? I didn't get the rest of it.
And indices.
Oh, and indices. Energy stocks are only a small portion of the S&P 500. It's about 5% of the weight of the S&P 500. But there are sub-indexes. There's an S&P 500 energy sub-index, and that is very sensitive to the price of oil. The price of oil is a major driver of the share prices of oil companies. But those oil companies are relatively small compared to the overall index. Higher oil prices also tends to be bad for other stocks, particularly for consumer stocks, because if consumers have to spend more buying oil, then that means they can spend less on all other goods, including transportation and consumer discretionary items.
I think that's it. Yeah. I think we've answered all the questions from the chat box.
All right. Well, thank you very much. It was really a pleasure to speak with you.
Thank you. In fact, I would like to thank you and the whole CME Group from the whole team of APM Capital Limited for joining this talk, giving us such wonderful insights of the industries of the energy market.